Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis and a warm welcome to Money Talk for Tuesday the 22nd of August. You can find this podcast on Apple Podcasts, where we're one of the most listened to financial podcasts in Hong Kong. We're also on Google Podcasts and Spotify. Just search for Peter Lewis's Money Talk. You'll also find the programme on Substack, Facebook, Instagram and Threads. Peter Lewis Money Talk is the page. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, China's central bank announced a reduction to its one-year loan prime rate and left the five-year rate unchanged, disappointing a majority of economists who had expected a cut to both rates. The People's Bank of China cut its one-year loan prime rate, which affects borrowing costs for households and businesses, by 10 basis points to a record low of 3.45%, while surprising markets by holding steady the five-year rate, which is a reference rate for mortgages, at 4.2%. Economists had expected a 15 basis point cut to both rates. China will push the BRICS bloc of emerging markets to become a full-scale rival to the G7 this week, as leaders from across the developing world gather to debate the forum's biggest expansion in more than a decade. South Africa's President Cyril Ramaphosa has invited more than 60 heads of state and government to a summit in Johannesburg from tomorrow, when several countries could be invited to join the BRICS bloc of Brazil, Russia, India, China and South Africa. China is reportedly pushing for an expanded membership that could include Argentina, Iran, Indonesia, Saudi Arabia and about 20 other governments that have formally applied. Federal Reserve Chairman Jerome Powell will deliver an address at the central bank's symposium in Jackson Hole, Wyoming on Friday. The theme of this year's Central Bankers Summit, which runs from Thursday to Saturday, will be structural shifts in the global economy. In the past, Fed chairs have used the event to outline their policy agendas, and ahead of the gathering, Harvard economics professor Jason Furman and Nobel laureate Paul Krugman called for the Fed to raise its inflation targets from the current 2% to a range of 2% to 3%. On today's Money Talk, we're joined by Asian fund management industry consultant Stewart Aldcroft, Geoff Howie, market strategist at the Singapore Exchange, and over in Washington DC, our US economics correspondent, writer and broadcaster Barry Wood. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street, US stocks rallied off their lows in Monday's afternoon session despite pressure from higher yields on longer-term treasuries. The S&P 500, which was down as much as 1% at the low of the day, closed 0.7% higher at 4,400. The Dow fell 37 points, or 0.1% to end at 34,464. The Nasdaq snapped a four-day losing streak, gaining 1.6% in its biggest one-day advance since July the 28th. Tech shares gained Monday, with the S&P 500 tech sector adding 2.3%. Nvidia rallied 8.5% ahead of its much-anticipated earnings release on Wednesday. And Tesla advanced 7.3% after plunging 11% last week following news of more price cuts in China. Yields on 10-year treasuries on Monday hit their highest since November 2007, ahead of a much-anticipated speech on Friday by Fed Chair Jerome Powell. 10-year bond prices slipped, lifting the yield to 4.35%, up 10 basis points on the day, while 30-year bond yields reached a new 12-year high of 4.45%. Two-year yields hit 5%, and real rates on 10-year inflation-protected bonds hit 2% for the first time since March 2009. In the currency markets, the offshore yuan weakened to as much as 7.3362 per dollar, its lowest level in over 9 months after the People's Bank of China lowered its one-year loan prime rates by 10 basis points. However, the currency rebounded to 7.2881 after China's major state-owned banks were seen snapping up offshore yuan on Monday, creating a liquidity squeeze. Onshore yuan was flat, trading at 7.2865 renminbi in Shanghai. And Hong Kong stocks fell to their lowest level since November after the PBOC disappointed investors and left its 5-year LPR unchanged. The Hang Seng Index slipped 328 points, or 1.8%, to a 9-month low of 17,623, adding to last week's 5.9% tumble. The index is down more than 22% now from its January the 27th high, putting it in a technical bear market. The tech index dropped another 2.1% after losing over 6% last week, and the moves follow the release of disappointing series of earnings across the tech sector. The China Enterprises Index of the largest offshore listings in Hong Kong sank 1.9%, and it's plunged 12.6% this month so far to become the worst performer among 92 global equity gauges. On the mainland, the Shanghai Composite dropped 1.2% to 3,093. That's its lowest level in 7 months. And you can get more details on the latest market movements in my daily newsletter. You'll find that at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
We have a very international panel of guests for you this morning. First of all, here in Hong Kong, our regular Tuesday morning commentator, Asia Fund Management Industry Consultant, Stewart Aldcroft. Morning, Stewart.
Good morning, Peter.
And down in Singapore, we find market strategist at the Singapore Exchange, Geoff Howie. Morning, Geoff. Nice to talk with you.
Good morning, Peter. Very nice to be here. Thank you.
And over in Washington, D.C., as always on a Tuesday morning, our US economics correspondent, writer and broadcaster, Barry Wood. Morning, Barry.
Good morning, Peter.
Let's start over here. China's central bank's announced a reduction to its one-year loan prime rate and left the five-year rate unchanged. Rather surprised a majority of economists who had expected a cut to both rates. The PBOC cut the one-year LPR, which affects borrowing costs for households and businesses, by 10 basis points to a record low of 3.4%, but it surprised markets by holding the five-year rate, which is a reference rate for mortgages, at 4.2%. Economists had expected a 15 basis point cut to both rates, and Monday's decision followed an unexpected reduction in both short-term loan rates and the medium-term policy rate by the PBOC last week. China had been expected to make the biggest cuts this year to both of its core lending rates as pressure mounts on policymakers to counter a host of economic challenges. Stewart, let me ask you to kick off on this. The PBOC has been talking repeatedly about releasing more liquidity for the economy. It wants to make adjustments for home mortgages to make them more affordable. It's been urging banks to increase lending, and yet it goes and leaves its main policy rate linked to mortgages unchanged. It's sort of sending out a bit of a confusing signal, isn't it?
Yeah, I agree. It is a confusing signal, and I've tried to rationalise this in the view that I think the PBOC is basically very inexperienced in this sort of situation that they're finding at the moment. They've not had a situation before, certainly not in the last 20 years or so, of falling GDP, rising unemployment, and massive debt out in the market. And I think at the same time as they're not cutting interest rates, I don't think like as fast as probably people are expecting, they're also concerned that they would be cutting interest rates at a time when interest rates are much higher elsewhere, and therefore their currency becomes even less attractive to international investors. There may be some degree of wanting to sort of try out one cut and then see if that works, and then try another cut. That's what they did last time. But it's not enough. And I think this is beginning to show the degree of inexperience of the PBOC in managing the Chinese economy. And I'm sure we'll talk a little bit about the property sector in a short while, but this is not helping any aspect of the economy when it seems like the PBOC is just dithering.
Dithering. Geoff, I mean, this is obviously an important issue for Singapore as well, isn't it? And Southeast Asian economies, what's happening in China. Do you think the PBOC is a bit lost, or the government is a bit lost here? Because it seems slightly odd. It surprised a lot of people anyway. It's in action yesterday.
Yeah, it's very interesting because I think there has been a little bit of an element of consistency, though, when it comes to not wanting to move against what their initial, economic focus was over a few years ago. So we know that the property sector, it's going obviously through the rut with the supply glut, and it obviously has so much of the debt that has been obviously in focus, particularly Country Garden over the weekend. And what I think is really interesting is that at the same time it's kind of looking to shore up stability and keep an orderly focus on markets so that capital markets can deal with this orderly, I guess, wind down in the debt, or sticking to that axiom that they always had in terms of not wanting to so-called bail out a property market. But you look at the measures that came in on Friday about, basically trying to facilitate and transparent, very efficient operating of markets and so forth. And the fact that like you said, the 5-year loan prime rate, which is more for home buyers and companies, wasn't cut as much. It now goes back to maybe there's something more in the reserve requirement ratio coming for the second half. I think most analysts expect at least 125 bips cut there. But I think liquidity is obviously super important. But I think they're just obviously sticking to their guns a little bit and making sure that they don't overdo it on too much support for the property market. That's it might be a little different to what the people think, but that could be an angle.
Okay, interesting. I mean, Barry, this is of concern to the US as well, isn't it? Janet Yellen has said already she's concerned about what's happening to the Chinese economy. I mean, in effect, we've had a 40-year boom in China since it really first started to open up. It's seen enormous economic growth, delivered a lot of jobs for people. Some people are worried now that, that boom has basically run its course, and now what we're going to see is difficult times for China, along the lines of what we saw in Japan at the beginning of the 1990s. What are your thoughts?
Yeah, I think you're onto something there. And I must say, having been away for a week in Britain, and you come back and the preponderance of news about China is just deep pessimism. I mean, there's a sense that, as you say, the boom is over and that they will not grow. And so, yes, they have the achievement of 700-800 million people being pulled out of poverty, but now you've got the exchange rate that is under deep pressure, and they're cutting rates and headed into deflation, or already in deflation, when the rest of the world is raising rates to fight inflation. So it's a peculiar thing. And I think one of the news bits that I focused on in just catching up was that $7 billion had pulled out of China in just the past month in terms of equity flows out of the exchanges. This is pretty worrying. So you can't find anybody in Washington, or at least that I'm reading, who's optimistic about China short term. And people think, in fact, it's going to get much worse.
It's often a good buying opportunity, isn't it, when people are most fearful? As Warren Buffett always says, buy when people are afraid, sell when they're being greedy.
That may be right, but I doubt it for the moment. I think we've got a lot further to go down, frankly, and I think we need to use the Rothschild analogy and only buy when the blood is on the streets.
But this doesn't help much the property sector, does it? I mean, people are looking for some real support for the property sector, which is hemorrhaging money. More and more property developers seem to be tumbling into the precipice. What needs to be done there? Because this is the biggest issue, I think, isn't it, that's facing the economy at the moment, and that most worries foreign investors.
Yeah, the extent of the debt of the property sector is simply enormous. It's bigger than the GDP of some countries, and that's just the property sector. And the property sector has represented something like 23 to 25% of the entire Chinese economy, which is far too high, and in any event will, at the end of this, come down. The problem with the property sector is there are far too many properties that are uncompleted, empty, not being sold, and the market, the buying market, believes that prices will come down. So why buy now if they'll be cheaper later? So, and then when you look at the size of the debt of just two companies, and and they're quite representative of many others, you're talking about $150 billion of debt. Well, where is that going to come from to save them? There's only the government out there capable of doing that, and it doesn't look as though it wants to. So I think the property sector has still got quite a long way to fall. I don't think we've fully taken it on board, even though some of the debt is defaulting and the prices of companies are declining quite sharply. We have to expect to see some serious bankruptcies coming about in that property sector in the near future. And that will then be the start of the end of the crisis. It won't be the end of the crisis, but it'll be the start of the end of the crisis. Bankruptcy is an important financial tool, frankly, and China is not used to that, but it will have to accept that this is the way forward.
Okay. I mean, Geoff, from a market perspective, there's two big things going on at the moment that seem to be risk-off for markets. One is this rise in US Treasury bond yields, which I want to talk about in the moment. But the second one is what's going on in China. It seems to be infecting global markets, doesn't it? And sort of some people are seeing this as potentially a big credit event for markets. How are you seeing it down there from a market perspective?
Oh, it's certainly impacted, Peter, and markets are, we're a little bit back to where we were in 2021, I guess, over the last 5-6 weeks in terms of the market moves were just so fast. STI, you had from mid-July to the end of July, the STI added something like 5%, and that was on the back of China also adding 6%. It was a little bit like buy the rumour for the stimulus, but sell the fact, because the next 2 weeks, 2 to 3 weeks that we've seen in August, you've had the FTSE China A50 index decline 5%, and that's impacted our market as well here. We've declined a good 5%, and it's not just from a market moving point of view as well. Our trade numbers, as we've seen in Taiwan and South Korea, have been in contraction since October. Industrial production as well has been in contraction here since October. And much of this anchors to, of course, the outlook for electronics and technology as well as the regional consumer. So we're still looking for signs of stabilization, Peter, and that's yet to happen. But in the meantime, it is certainly creating something of a roller coaster in the market. I've never seen a symmetrical move up so quickly and down so quickly at the same momentum as we've seen in both our FTSE China A50 index and the Straits Times index.
Okay, interesting. And Barry, I want to ask you about BRICS. The Financial Times is reporting on Monday that China wants to push the BRICS bloc countries of emerging markets to become a full-scale rival to the G7. And South Africa's President Cyril Ramaphosa has got more than 60 heads of state and government going to Johannesburg for the BRICS summit. China wants to expand the membership to include Argentina, Iran, Indonesia, Saudi Arabia, and a host of others, although India disagrees with whether the BRICS should be a sort of a more political force. What do you make of this? I mean, this sounds like a sort of politicization of the BRICS altogether, doesn't it? I mean, originally it was just a name, just a term for a group of emerging market economies.
Yeah, I think it's a fascinating development, and I think it's very hard to predict what is going to happen. But you've laid out, I think, the questions before this Johannesburg summit. My own view is good luck. I don't think it's ever going to happen. You can't get Jim O'Neill, the financial man in London. He invented the term, of course, and he had to do. It was about these countries becoming investment targets, and the two winners were clearly India and China. Russia and Brazil have not done well, and he has said so explicitly. But then you hear all this sudden talk, South Africa having been added to the group sometime later, that they're going to set up their own currency. And he said, are they going to have their own central bank? And of course, they're not. And I think this notion of bringing in new countries is very risky. You know, not very many people will remember that back in the 1960s, you had the Group of 77, which was just a lobbying group, a caucus of poor developing countries. Well, the risk for the BRICS is that if they expand their membership, they could become just like that. Now, at the same time, there are some positive developments that the BRICS could deal with, and that is you've got Saudi money. The Saudis want in, and the Saudis can make the BRICS bank work, because so far it's been a very small bank. You also have the development that the Americans and Europeans, having frozen Russian assets, have really forced Russia and China together. And that alliance has made, well, first of all, oil prices for both China and India have been very low, and they've bought all they could because they haven't been, abiding by the sanctions that have been set. I think the risk is that, as Jim O'Neill again says, there's never been a case that India and China agree on anything. And that India, current chairman of the Group of 20, says we don't want to expand and we don't want to be an advocate of developing countries only. Then you've got China, who's pressing for expansion, who wants to promote the renminbi as a global rival to the dollar, and you've got the Brazilians somewhere in the middle, and the South Africans, frankly, don't count. The danger of the BRICS is that they could become, absent China and India, an association of failed states. I mean, after all, Iran wants to come in, Cuba wants to come in, Argentina has the highest inflation in the world, Zimbabwe, so it's a huge problem. I think it's going to be fascinating, Peter, to see what actually happens with all these countries meeting in Johannesburg, what kind of agreement they can agree to make in a formal statement.
I don't disagree with you at all there, Barry. I just think that anybody who thought that they might want to join an economic community which includes Vladimir Putin and Russia, I just don't see that happening. Russia is the pariah state in the world, and it would be sufficient to put off almost anybody other than another rogue state to join.
I mean, I presume there is one positive from this, which is that together, maybe these nations could push for better debt reduction terms, more debt reduction in some of the poorest nations in the world, because the BRICS countries do represent, don't they, some of those nations that are struggling with a lot of debts. Do you think that could be a positive from them working more closely together?
Not really. I think that they've got plenty of other objectives. I don't think, and each of them have got their own problems. So unless they're sharing their problems elsewhere, I doubt that will happen.
Yeah, I think this is a potential positive, Peter, because this, after all, is the 15th summit they've had. So these countries and their ministers know each other. And there is the BRICS Development Bank. That's an achievement. There is a mechanism for bailing each other out if somebody gets into financial distress. That's a positive. I think they would like to have some rivalry to the dollar using their own local currencies. That's a positive. But to say they could rival the G7 as a steering committee for the global economy is frankly absurd, because they don't agree on the matters themselves. So I think it has potential, but it's at risk. I think the greater risk is abject failure.
Geoff, from Singapore, I mean, obviously one of the countries in Southeast Asia that wants to join BRICS is Indonesia, which is, well, it's probably the fastest growing economy in the region at the moment, isn't it? So are there benefits?
Yeah, I mean, I think, this really comes back to where we looking at in the world in terms of all this geo-economic fragmentation, I think, Peter. I mean, it will be fascinating to watch what happens in South Africa, but as Barry said, that where the future of multilateralism now goes really will depend on, I think, how China and the US both fare in terms of their relationships going into next year, particularly as the tech cycle starts to pick up as expected again, coming out of its contraction of this year. There's Yeah, it's for ASEAN. The integration has been working particularly well in recent years because of the influx and the need for green mining. Basically, all the minerals such as cobalt and nickel and lithium and copper that goes into producing rechargeable batteries for the motor cars, the EVs. Much of that green mining upstream activity is in, as you know, Indonesia and Philippines, and then we have a lot of midstream and manufacturing throughout ASEAN. So the amount of money that's coming from the world to invest in, I guess, as an upstream power hub for EV activities in ASEAN is really seeing us progress more in reducing customs and transportation costs that have in the past been, I guess, the biggest barriers for ongoing integration in ASEAN. So, if you've got a good economic thread for this multilateralism, then I think you've got a great purpose and you can find momentum. But yeah, finding that economic thread's going to be really important.
Okay. Well, in the time we've got left, let's turn our attention to the markets. The yields on 10-year treasuries on Monday hit their highest since November 2007, ahead of a speech on Friday, which is much waited for by Fed Chairman Jerome Powell at the annual Jackson Hole Economic Summit. 10-year bond prices slipped, and that's taken the yield now to 4.35%. Geoff, you're our markets man. Are markets ready for you? I mean, this is now, it's very clear, isn't it, that 4%, which pretty well since the global financial crisis has been a ceiling for yields, has now become the new floor. And we're going to have to get used to rates above 4%, 2-year rates at 5%, real rates at 2% as well. This is a new environment, isn't it? Are the markets ready?
Yeah, it might. A bit of a structural step up. Markets are watching very closely. The expectations for where the FOMC will be on the 13th of December, just since those minutes were released last week, have increased. The rates for another 25 basis point hike have increased from something like 25% to above 40% now. Those minutes, they had those two scenarios: supply chain improvements or favourable commodity price trends don't continue, or you have aggregate demand failing to slow by an amount that fails to slow by an amount that's sufficient to restore price stability. That could cause more persistent elevated inflation in the US. That was the key takeaway from the FOMC minutes that have seen those expectations rise, added that extra step up for the yields. Because you look at the actual information that's coming through since those minutes have been there. You've had more than 90% of the US stocks now report their earnings for the second quarter. You had double the amount of stocks that actually beat earnings than those that missed. So just like the first quarter of this year, those earnings have been better than feared. But also you've got on the energy price as well. I think WTI is now at $80 a barrel versus $70 a barrel at the end of June. Brent crude's up $10 a barrel as well. So I think what it means is, obviously, all eyes will be on the PCE core deflator, which I think is the 31st of August, and expecting a little bit of uptick because of energy prices like we've seen in much of the advanced world. But also, Peter, there's, I think, a structural change too in terms of the four new incoming FOMC voters. Tom Barkin, Raphael Bostic, Mary Daly and Loretta Mester are all incoming FOMCs, and they were saying at least just as long as 4 weeks ago that inflation was still too high in the US. So I think much of those higher yields is driven on the back of that.
Stewart, we're in a bit of an odd situation, aren't we? Because the Fed has sort of signalled that it's, even if it isn't completely done, it's close to being done. Central banks, certainly around Asia, are signalling very strongly that they're going to pause and leave rates on hold. But here we have the situation where, despite that, yields are continuing to rise and rise quite rapidly.
I think there will be another 25 basis point increase in Fed rates, whether it's in September, which is the next scheduled meeting, or after that, I'm not entirely clear. But I think the Fed, it's right in saying it's nearly done, but it's not done. So at least another 25 basis points would be not unreasonable. Yes, they are concerned about inflation, and rightly so. Inflation is not falling in the US anymore. It's gone up a little bit recently. And I think that there is still concern that they need to keep control. Unemployment rates in the US are pretty low, and that is helping to keep the economy very strong. So whilst the economy is strong, it makes sense to take advantage of that by putting rates up. I know Barry might not agree with me on that, but I think that, and he's the one that has to suffer the higher rates if he's paying for a mortgage. But on the other hand, it's this is just the way I think it is at the moment. This is the trend.
Yeah, I think the Powell speech on Friday is important. A year ago, he was talking about fighting inflation, and he's done it. Mm-hmm. And I think they will continue the inflation fight. But, at some point, these higher interest rates, and Peter, you mentioned how rapidly the 10-year and by implication, the mortgage rate in the United States has risen. I was looking at the average home buyer now at 7% on a 30-year mortgage is paying $400 more per month. That's a big hit. So is the recession threat over in the States? I think it is, but certainly a slowdown is in fact engineered and is going to take effect. I think the Powell speech will not be a surprise, and probably markets will like it. But there's been an immense positive development in the States in all aspects of the economy over the past 12 months.
And what do you make of these two high-profile economists, Jason Furman, he's an economics professor at Harvard, Paul Krugman, Nobel-winning, prize-winning Nobel laureates? They're both calling for the Fed now to raise its inflation targets. They're saying that 2%, when it was first set, it was a very arbitrary target, and if you were to start again now, you wouldn't pick 2% as the inflation target, and they're suggesting that the Fed moves gradually to a new range of 2 to 3%. What do you make of that?
Well, I'll defer to Geoff and to Stewart on this one, but it seems to me it's very clear this is the wrong time to send that signal. I don't think it makes a great deal of difference if it's 2 or 3% as an inflation target, but certainly not saying it now when you're in the midst of an inflation battle.
I entirely agree with you. What's the point of moving the goalposts? The game is still being played. Let the game finish first.
Geoff, final word to you.
I think find it good kind of track of thought, but find another way to not move the goalpost, but find another policy to help rein it in.
Presumably, if you change the inflation target to 3%, then anyway, 3% sort of becomes the new floor, and you have to start getting used to inflation at maybe 3.5% instead. So it's sort of, as you say, it's sort of the wrong signal to send out at the moment, isn't it?
Yes, it's not the sort of thing a central bank would want to do.
Yep.
It has implication for wages, implication for corporate margins, implication for Wall Street.
Yeah.
Okay, sounds like we're all agreed. That's good. Good note to finish on. Thank you all very much. You heard there Geoff Howie, who is market strategist at the Singapore Exchange, Stewart Aldcroft, Asia Fund Management Industry Consultant based here in Hong Kong, and Barry Wood, our Washington, D.C. based US economics correspondent.
Peter Lewis's Money Talk.
Thank you for listening to Money Talk this morning. You can find more business and finance information from around Asia in my daily newsletter, which is at peterlewismoneytalk.substack.com. I'll be back tomorrow when I'll be joined on the show by Carlos Casanova, Senior Asia Economist at UBP, and Frederick Chu, Managing Director at Magnum Research, with a view from Japan is Tokyo-based journalist and author William Pesic. Have a great day.
Money Talk